Welcome back, everybody. So today I want to discuss the 3 top financial mistakes that I see a lot of real estate professionals make. Now, keep in mind, this is all my own personal experience, so everything I'm going to talk about is pretty much anecdotal. But I think we can learn some lessons here, kind of overgeneralizing maybe, on some things to avoid doing so that you avoid kind of walking into a minefield without even knowing it if you're a real estate professional. Because if you do a lot of this stuff wrong, or you do some of the stuff I'm going to talk to you about, not only is it going to cost you money, it's going to cost you potentially time and hassle as well. And we all know the best resource that we have to work with is time. So if we can avoid wasting that, it would be ideal. So number 1, I see a lot of real estate professionals fail to make estimated quarterly tax payments to the IRS. Now, I see a lot of junior agents doing this as well as a lot of senior agents as well, which was kind of surprising, to be honest. And frankly, I think that's because a lot of the more senior agents have been able to either A, they've gotten away with not making quarterly tax payments for whatever reason over the years, or B, they don't know that they've actually been paying a penalty and interest to the IRS for not making the quarterly tax payments at the time they're supposed to make it. Because we have a pay-as-you-go tax system. So you should really be paying as a self-employed individual or a 1099 individual being paid from their brokerage as an independent contractor. They're not holding the taxes for you. They're not paying the taxes for you like if you were a W-2 employee. So it's on you to pay them. But a lot of people think, oh, well, when I do my taxes, I just pay them. When I do them in April or March or whenever they end up actually getting to them. And they don't maybe realize because either their accountant maybe isn't explaining it to them or they're doing them themselves, which tends to be the reason that I see the most is doing your taxes yourself. You might not realize as you rush through it that you're actually also paying a penalty to the IRS. So the way to avoid doing this is work with a professional. Work with a good accountant or a CPA that can help keep you on the straight and narrow when it comes to paying the quarterly estimated tax of the IRS, because there's a formula that you can use and certain situations that are on the IRS website, which I'll link to the frequently asked questions below in the episode notes. There's ways to figure it out on your own, but it's best to really work with a professional that knows how to do this as part of their day job, and they can keep you from getting into too much trouble, because we don't want to waste money just for the sake of not knowing what we're doing. So number 2, I see a lot of realtors and real estate professionals trying to deduct personal expenses as business expenses on their taxes to lower their tax bill. Now, I understand why this happens. There's a lot of things that go into building your real estate business, and maybe you saw it on Google somewhere or another agent somewhere told you that you could deduct X, Y, or Z to lower your tax bill. And a lot of times if you enter that stuff into, let's say, TurboTax, it'll let it go through and put it on your return and send it off to the IRS. And you think, oh, well, it accepted it, so I must be in good shape. When in reality, when it comes to those self-serve tax softwares out there, it's garbage in, garbage out. And it's not going to stop you from putting the wrong stuff in if you just misunderstand how the rules actually work. So to give you an example, a few weeks ago, I was talking to a realtor. And this person was telling me how they go ahead and deduct all of their clothing expenses on their taxes as a business expense. So as I dug a little bit deeper, it's more the nicer type clothes that this person was deducting on their taxes. And I understand their reasoning. They thought that, well, since they work with a lot of affluent people and they list a lot of multi-million-dollar homes, that they need to project a certain professionalism, a certain level of fashion, shall we say, in order to swim within those circles. And they thought, well, I wouldn't really be buying clothes like this on my own. I do it for my business, so I can deduct all this stuff. Now, while it kind of sounds like maybe if you do a quick read of the rules that you could do that, in reality, you can't generally do that. So if you think about if you're buying clothes, if you can wear them, if you can reasonably wear them in a normal everyday setting, like if you buy nice clothes, you could wear them to church, you could wear them to a nice restaurant, you could wear them just out and about town, the IRS says that you can't deduct those. But types of clothing that you can deduct, for example, if you're a medical professional, a doctor or a nurse, you can deduct, let's say, the scrubs that you have to buy on your own that you only really wear reasonably on your shift. Those types of things you can deduct because nobody would reasonably expect you to go out to a nice restaurant or go to dinner wearing your scrubs. So the solution to this is similar to the first one. Work with a good accountant, work with a good CPA that can help keep you on the straight and narrow on what you can and can't deduct. Because there's plenty of expenses out there that you are entitled to deduct as a realtor, and you really should. And one of the ones off the top of my head is the vehicle expenses that you rack up. Driving all over town or driving all over your state, showing properties, taking buyers around. You are entitled to write off those expenses, but you got to keep good records and you got to keep good substantiation for the IRS. And another kind of misconception there, if we're talking about cars and mileage expenses, just because you slap a magnet on the side of your car does not entitle you to write off every single mile that you drive in a given year as a business expense. That isn't really going to fly as a marketing expense or a vehicle mileage expense just because you have a magnet or some sort of wrap on your car advertising your real estate services. So mistake number 3, I see a lot of real estate professionals end up having a highly concentrated, highly risky real estate investment portfolio that they don't really appreciate how much risk they're actually taking. And it makes sense. I understand why real estate professionals prefer to invest in real estate. Obviously, in the profession that you're in, you appreciate the time-tested way that real estate can build wealth. However, there's 2 ways that people can kind of get into trouble using this as their primary wealth building tool. And that's leverage and also over-concentration in a single area. Now, leverage can be very useful in building wealth in a shorter amount of time. However, if you're borrowing money, you're also exposing yourself to macroeconomic factors and downturns in the economy or any other things outside of your control, where if you've used leverage and borrowing to increase your buying power, it can also substantially increase your losses if things were to turn against you. So some people really tend to over leverage beyond what they're really capable of absorbing in the downtimes. So you want to try to avoid that if you can. And the other thing is a lot of folks tend to be over concentrated in a single area or a single type of real estate. So what you want to try to do in order to lower the risk on these types of things is diversify out. Either diversify in different types of real estate holdings, different types of real estate assets, or try to use as little leverage as possible to try to mitigate the risk of you going bust if things were to go south on you because of conditions outside of your control. However, there's a third way to really mitigate the risk here, and that is to not put all your eggs in one basket. Don't put all your wealth building hopes and dreams into real estate. You can also invest into stocks and bonds and other things like that to really diversify out your risk. And I know a lot of real estate professionals maybe don't like the stock market because they think, oh, it's very volatile, it goes up and down more than real estate. However, volatility is not risk. So if you're investing for the long run, volatility can actually be your friend. It can give you opportunities to buy at a lower price and be able to actually sell at a higher price when it comes time to actually take the money out. However, the same reason a lot of people like to invest in real estate is the same reason why investing in stocks can also be beneficial in the long run. If you zoom out over a long enough time horizon, real estate prices and valuations tend to go up. And it's the same thing for stock prices. So as long as you've got a good long-term mindset, it can really be a useful tool to diversify out your risk, to diversify in a broad wealth portfolio of real estate, stocks, bonds, and other types of financial products that can diversify you out properly. So I hope this has been helpful for you. If there's any sort of topics or anything you'd like for me to discuss further in the future, go ahead and shoot me an email or a note, or go ahead and leave a comment below, and I'll add it to the repertoire and look at talking about it here in the future. And as always, take care of yourself, and I'll talk to you all next time.